how can the UK go back to a period I wasn't even here? But there's also double taxation. And the real sting in the tail is the fact that the longer the capital gains have been within the trust for this purpose or deemed to be within the trust, the higher the tax rate.
Welcome to the US-UK Tax Talk podcast. Thank you so much for listening again. I'm Aidan Grant, a partner in the tax and estate planning team here at Collier Bristow. On this episode, I have the pleasure of being joined by Gillian Everall, Managing Director of Everfair Tax, a US-UK tax advisory and accountancy firm. Gillian is also my first repeat guest, having first recorded an episode with her back in 2021, so I'm very grateful for Gillian for joining. We hope you enjoy the episode. Gillian, good morning. Thank you so much for joining me. How are you today?
I'm good. Happy Friday, Aidan.
So, for the viewers, we have the pleasure today to be joined by our first repeat guest. I have the pleasure to be joined by Gillian Everall, the Managing Director of Everfair Tax. Gillian, thank you so much for coming on again. You really must be a glutton for punishment. Before we start to talk about what the theme and the topic is for today, why don't you introduce yourself to everyone?
Of course, be happy to. I'm the founder and managing director of Everfair Tax. We're a US-UK specialist tax consultancy business, and I've had the pleasure of knowing and working with Aidan for more years than I care to refer to at this point in time without wanting to make either of us seem too old, and particularly on the topic that we're going to talk about today.
And that topic we're going to talk about today is a repeat of the topic that you and I, Gillian, discussed. I was just checking my information. It was September 2021 when you came on very graciously the podcast for the first time to talk about US revocable living trusts. It has proved to be, over the last 4.5 years, one of our most popular episodes. I think not only, Gillian, because your clarity and your generosity of thought, but also because I think it's a topic that really affects a lot of Americans when they are connected to the UK for various reasons. And I wanted to have the chance now, these years later, to reflect on where we've come in those 3 years, the changes in the UK tax code that have affected the way in which you give this advice. You and I might grumble about how much there's a lack of development from the Revenue Authority in the UK as to how they deal with those things. But it's a chance to kind of pause and reflect and start again in thinking about these structures. So thank you not only for coming on again, Gillian, but also for coming on to talk about the exact same topic.
No, my pleasure, Aidan. And I was delighted when you suggested it on the grounds that it's come up more and more and more over that 4.5 year period. Can't believe it's been that long, but we'll gloss over that. It's a topic that's not going away, Aidan. So it's one that's crucial to talk about.
Absolutely. So here's what we're going to do on this episode. Firstly, I think it is important to recap what revocable living trusts are. When we refer to these things, what are they and what are they not? We'll talk about them in the light of the UK tax changes that were introduced on the 6th of April 2025, and just pause and say, has anything become easier for people? Spoiler, yes, some things have become easier, but also more importantly, what hasn't changed. And then we're going to think about the ways in which living trusts arise within a kind of US-UK tax context most frequently, and give some thoughts and some guidance onto what people that are affected by these issues should maybe be thinking about doing. From your perspective, Gillian, when someone comes to you and says, I have, or I think I might have a living trust, or they say, but I'm not entirely sure what this concept is, what is your elevator pitch for what a revocable living trust is?
The biggest context for us is probate planning. It seems that every estate lawyer, even the tax advisors in many states in the US, it's one of the first things that they suggest. Principally, their view is it allows a much swifter access to assets after someone passes for the beneficiaries and really reduces the probate fees costs that are incurred in getting an estate resolved in a number of states in the US. California,
for example.
Just naming a couple.
Unfortunately, some of the states where people most frequently come to the UK from.
Yeah, absolutely.
And I think you're right to speak of a living trust, because I think we'll refer to them as living trusts just for the sake of convenience. As an estate planning tool really is to reiterate the point that for many American practitioners, a living trust is as common and as important as a will. And they go hand in glove frequently in an estate plan. So rather than I, Aidan Grant, holding my wealth in my own name, as one would typically do in the UK, you hold your assets via this kind of alternative structure that has a different title to you. You are the trustee of this living trust, but for all intents and purposes, and this is where the then tax feeds into it, from a US perspective, the money being held in the trust or the property being held in the trust is treated exactly the same for US tax purposes as if you just didn't have a living trust and you held them in your own name. So from an American estate planning perspective, it's kind of all upside, no downside. You have the exact same US tax treatment, but hey, you also have the chance to avoid probate. And I presume when you're doing this with your US practitioner hat on, your US tax advisor hat on, Gillian, that's actually very straightforward because you know you haven't really got to concern yourself with the living trust from a US tax perspective. Am I right?
You're absolutely right, Aidan, and you're right to say from a US tax point of view and from a US legal point of view, they make absolute sense. They're written in a way, the individual funding them, it has full access, generally is the only beneficiary during lifetime. I can see every day why people would put these in place, particularly where there's US real estate, US accounts, because it is so hard otherwise to get accounts transferred to the name of the estate and then ultimately to the name of the beneficiary, which worries a lot of people. As I say, they're sort of thinking, well, what are my dependents going to do for money otherwise? And then you have the absolute nightmare of having to explain the differences from a UK perspective, and why they really, really need to think carefully, take advice, and consider whether the structure is still the right thing for them to have going forward.
Let me see if I can lace this with the most sarcasm I can possibly muster as a British person. Are you saying, Gillian, that the UK tax consequences of Revocable Living Trust is not as straightforward as an American? Are you suggesting that we've actually got a podcast, in fact, now 2 podcast episodes to talk about this? It's more complicated in the UK. No, was that enough sarcasm? So yes, more sarcasm. And this is the point I always try and start people on: is the UK does not have a concept of a living trust. The UK cannot say this. We have this similar thing. A grant or trust, a US income tax concept, is a US specific concept. There is a specific US tax treatment given to this trust arrangement, and the UK doesn't have a grant or trust. What we have, and what happens in international planning, is where you don't have a exact same structure in the jurisdiction in which you're concerned about. You look to what is the next nearest thing we have in the UK, and we'll try and tax it that way. Or, as in the case with living trusts, we kind of fall between 2 pillars, and sometimes we look like pillar A and sometimes we look like pillar B, and maybe we can sort of have a discussion about which pillar we're more closely aligned to. We're going to come on to sort of remind people what those pillars are, but the bit that I know that you wanted to talk about, or you wanted to make sure that we stress very clearly, Gillian, and I was very sort of much in agreement with you, is there is no established law in the UK on the appropriate UK tax treatment of a living trust, which has certainly, in the time since we recorded the first episode been the case, but also long before then, meant that there is just this great deal of uncertainty in the UK about the absolute clarity as to what taxpayers should do.
You're absolutely right, Aidan. Last time we spoke, we hoped that we would get greater clarity. There was a lot of hype around taking a case on a grantor trust to UK tax tribunal, and hopefully all the way through to get a definitive legal viewpoint and case law that we could hang our hats on, so to speak. Didn't happen, doesn't appear to be on the agenda any longer. That's quite interesting. What we have had in the meantime is a really unhelpful adding to the grey bit of guidance from the revenue where they say facts and circumstances. These may be settlements from a UK tax perspective. They may have consequences. We will consider each one in accordance with the terms, the exact terms of the deed. No way to even have core principles where you can guide clients as to what provisions they can include, what provisions to definitely not include in order to have a greater clarity of understanding of the tax position.
I completely agree with you about this uncertainty. And I think what I end up saying to clients a lot of times is that what we are in effect doing with the law as it currently stands is we are forming a filing position. We are offering analysis as to the strength of argument that a given living trust should be treated, in A rather than B. And we can't be definitive because there is no established case law. There's no Supreme Court case on which we can hang some analysis. It's not like, for the sake of argument, dealing with a limited liability company which has its own tax complications, and HMRC has a very strong view as to how they're treated. But there is a leading Supreme Court case that says you can treat them in this way if the facts are in this sort of, current guise. There is no equivalent case in living trust, and so we can't hang our hats on anything other than general common law principles. And I end up saying a lot of times to clients, look, this trust has some good elements, but it also has some less than good elements, and let's focus on the good elements. If we have the ability to do so without incurring tax consequences, to kind of move away from some of the bad elements, maybe take those elements out, particularly if the thing hasn't been signed yet, we give your beneficiaries or you a stronger argument in the future that no UK tax is going to arise. And that's really, that filing position is really the strongest thing we can do at this point in time.
100%. It's really the only option. It's a case of working together with someone like yourself, formulating a viewpoint as to where you stand in terms of legal treatment, assessing the powers, advising the client as to the options available, the risks involved, on our side, attempting to kind of quantify the tax implications, so that they're aware of the amounts involved. And those can come as a bit of a shock. There's often a lot of frustration, but you can really kind of help guide someone through the process in getting to that filing, as you say, filing position, fully disclosed on the return, outlined as to exactly why it's been treated the way it has, and you move forward from there. And it's frustrating, but it's the best we can do at the moment.
And I think you're right in that forming that filing position and forming it early is always going to be the better option, which also means, if possible, getting in front of this discussion before a document is signed, be it the grantor themselves that's in the UK thinking about their estate planning, be they a child of a grantor in the US who's putting this sort of planning in place. If we as the lawyers certainly can be on the ground at the beginning of the discussion where we can shape the narrative about the form of the living trust before it is signed, that's going to be easier than doing it after the document is signed. And from the perspective of clients that I know, Gillian, you and I have shared previously, even better than if sadly the grantor, say, has passed away and the tax consequences have crystallized, because at that point we have no ability to change the facts. We have no ability to change the terms of the trust. We are left with what we are left, and we try and form the best possible arguments. You and your colleagues try and do the best possible tax analysis, but eventually what will be will be.
Exactly right. And something I've encountered very recently, and which will form kind of quite a good illustration of the potential tax issues that clients can face where this is something that they literally can't do anything about. So I couldn't agree more, Aidan, and that's why, as I say, we work together so well on things like this, because if you can steer in advance, make sure that they're fully aware of the consequences for any UK resident beneficiaries, those have been fully considered and it still makes sense. Perhaps they can consider something else for the UK beneficiaries, where there's a family, as is often the case with us, a family where you've got US resident beneficiaries and you've got UK resident beneficiaries, that's where it's absolutely vital if you can get in there early, because you can very much make sure that what's being done works as well as possible. But you've also got to keep in mind the reason that this is being done. So there is always a cost-benefit analysis. It may still be the right option, but at least the decisions are being made on a fully informed basis.
I think it would be helpful because I am conscious that we do have a previous episode talking about bare trusts and settlements and what the various kind of ways a trust can be characterized is. And that episode exists, and we can certainly encourage listeners to go back and listen to it, although we won't have you on video that time, Gillian.
Probably better, Aidan.
What I want to think about now is, where are we now in 2025? And also something that I don't think we spent quite enough time talking about on the first episode is whether grantors themselves are UK resident, because that's where a lot of the additional complexity comes in. Certainly as regards these tax changes that came in 2025, and just to kind of try and knit these two pieces together, the issues relating to UK resident beneficiaries of, say, their parents' estate planning in the US that might contain a revocable living trust, those tax changes that came in April largely don't affect that position. The UK tax rules that relate to offshore trusts or bare trusts or gifts and inheritances from parents largely are the same. It's grantors in the UK, it's people in the UK who set up their own living trusts that are perhaps most affected by these tax changes. And so perhaps what is going to be most useful for people listening or watching this episode is to think about that context for what should someone now think about in the 25-26 tax year and onwards if they have this living trust. So why don't you give us a sort of a recap, Gillian, on what has changed in UK tax law as regards income and capital gains, for example? Now we're in this post-domicile world, and then we'll think about what that means for the living trust.
Absolutely, Aidan. And I've had this conversation, as you probably would expect, many times in the run-up to April 2025. It was a bit revolutionary. The main differential for the subject we're talking about is the income and capital gains tax position. Pre-April 2025, you had a really lovely world where income and capital gains could be kept relatively protected from the charge to UK income and capital gains tax. There was a reason why they called them protected settlements. What this meant was you were in control of when income and capital gains tax was triggered. If you didn't need a distribution, even if you were on the worldwide basis, as long as no money was paid out to you or an immediate member of your family, happy days. Everything rolled up tax-free. There was also what they referred to as a switch off of the settler interested income and capital gains tax position, which meant that the normal rules which would apply in connection with a UK resident and domiciled settlor creating a trust, if they had an interest in the trust, if they could benefit, as we've already highlighted, is inevitably the case with a grantor trust arrangement, a living will, as we agreed to refer to them. That was very advantageous. By switching these rules off, what would normally have been the case, all income, capital gains would be taxed as if they arose to you directly. The tax position in the UK didn't mirror the US, where there was that flow through of income and capital gains. Given our higher rates, particularly with respect to income, that was a huge advantage, an absolutely huge advantage. So as of 5th of April 2025, we're in a world where income and gains will be taxed on the settlor as they arise, if they retain a benefit. So yes, there's marry now going forward between the US and UK income and capital gains tax position, but global liability inevitably is going to increase.
I think the thing there that is useful for people, because I agree people will hear, now they have this worldwide exposure on their living trusts, whereas before they might not have done. I think the thing from my perspective when I'm thinking about the legal analysis that I provide is from a for a grantor who's living in the UK and has a living trust, and let's not make it more complicated. Let's say they set the living trust up while they're in the UK. For the income and the capital gains as the trust is in existence, it doesn't really matter the characterization of the trust from an income tax and capital gains tax perspective, because the settlor, what we call the settlor, the grantor for US purposes, is taxed on the income and the gains as they arise, irrespective of the characterization, whether we have a bare trust or whether we have a settlement. And that at least makes it easy. It might make the person think, well, then what does it really matter whether I have A or B, whether I have a bare trust or a settlement? And the problem is there are other ways in which the tax code will still bite on you in a disadvantageous way, usually when you have a settlement. But it is at least of, hopefully, some comfort that at least in one aspect of living trusts, that the UK has fallen into line, so to speak, with the end result tax position as the person would expect to have been taxed in the US on their income and gains. And I want to sort of trumpet that as at least a, albeit small, sort of victory for the taxpayer, whether you as the tax advisor filing the tax returns find that actually the filing is still different and the way in which you do it and the rates are larger. You know, I defer to you as the leading authority on it. But my perspective of advising clients, I at least find that part slightly easier.
Oh, and you're absolutely right. And in compliance terms, and in terms of ensuring foreign tax credits line up and we don't incur potential double taxation, 100% life is more straightforward. The taxpayer in the two jurisdictions is the same. The tax point is the same. The reporting, it's all on the individual's tax return. Arguably, there's no need to file a UK potentially tax return, which we would have had to do. Less record keeping for the trustees. All of it is much more straightforward administratively.
If you thought this entire episode was just going to be Gillian and me talking about how nice the weather is now, I'm afraid this is probably the part where we're going to explain that actually there are significant clouds on the way, because there are several places where, for a UK resident grantor of a living trust, there are still some very important points to note for UK tax purposes that could give rise to adverse UK tax consequences. So you still need legal and tax advice on your living trust. One is, and I'll sort of preface them all at the beginning, one is if you create your trust before you come to the UK and what the consequences are for taking money out of the trust. One is if you set the trust up in the UK and it happens to be a settlement, the tax consequences that can arise for setting the trust up. And the other is if the trust has UK resident trustees and what that means for our new foreign income and gain regime. Perhaps take them very, very briefly, the canter, Gillian, in that order. If someone sets a trust up before they come to the UK and that trust starts its life as a foreign trust for UK purposes, then, you know, please tell me I haven't been giving the wrong advice for the last few years. If that is a settlement for UK purposes, so it's the quote-unquote bad type of trust, the one that most people don't want, when they come to the UK, in withdrawing money from that trust, so we're not talking about the income and gains as they arise, but when they want to pay money to someone or they want to pay expenditure on liabilities, the act of taking money out of the trust can still engage the UK anti-avoidance rules, what we refer to as Section 87, on taxing the individual on taking the money out, because this trust was a trust that was foreign for UK purposes, and so it contains stockpile gains and possibly relevant income, and the withdrawal from that trust is still highly tax disadvantaged in the UK.
You're absolutely right to highlight the throwback element of Section 87. There is always a huge shock and drawing in of breath where I have to say to a client, you've got this structure. If it were to be a settlement, we would need to look back to the point of creation in terms of considering how many capital gains there are, which would then be allocated for UK tax purposes to any capital distribution that you receive during your UK resident period. So they're always in shock. But I've paid US tax on those items as they arose during my US residency. Completely appreciated. And I can't help myself and say that yes, it's grossly unfair. Yes,
It
I
is.
don't agree with it or like it, but the rules are quite clear in this respect. You have to go back to when the trust was created, assess all the capital gains, look at what's been distributed, non-distributed, come up with a pool of capital gains, which for UK tax purposes can be, assessed as and when amounts are drawn during UK resident periods. And that's painful because we also can't get a foreign tax credit for the tax already paid. So there is not only this, how can the UK go back to a period I wasn't even here? But there's also double taxation. And the real sting in the tail is the fact that the longer the capital gains have been within the trust for this purpose or deemed to be within the trust, the higher the tax rate because of the additional surcharge that kicks in after a 2-year period.
Yeah. And thanks to the government in 2024 raising the rate of capital gains tax, the surcharge on top of the increase in the capital gains tax also makes the highest rate of that
Correct.
throwback supplementary charge also higher as well. And this is why I say to clients who maybe are thinking of coming to the UK or returning from the US, this is why it's still important, even though the income and the gains when you come to the UK are going to be taxed on the arising basis, irrespective of the characterization of your trust. The identity of the trust is still very impactful because if you come to the UK with a settlement, then the UK is going to tax you on these withdrawals for the reasons that you and I have just alluded to. Whereas if we can convert the trust into a bare trust before you come here, that ought not to apply. And when you come here, and actually, Jill, this is a point which I don't think I've actually looked at in the rules, but maybe you have. If I come to the UK and this trust has UK resident trustees, wholly UK resident trustees, and the UK would consider this trust a settlement, the bad type of trust, have I also precluded myself from claiming the foreign income and gain regime on the income and gains within the trust because they are arising to what the UK would consider a UK resident trust, even if the attribution is then to the settlor as a UK resident settlor? My concern is that if you qualify for the 4-year foreign income and gain regime, you might also be precluded from benefiting from that regime if you've brought your trust into the UK and now have a UK resident trust. I don't suppose you've looked at that yet in the rules.
We've certainly considered it as a minimum because there is a clear requirement even within a settler interested trust that if the income is not mandated to a beneficiary, which means for this purpose it doesn't go to them directly, if it flows through a trust account or is reinvested within an investment portfolio and doesn't go directly to the settlor, you have to file a UK return. And if you're having to file a UK return, you, as an absolute minimum, have to pay the basic rate of UK tax. Whether or not HMRC will agree with the analysis I've heard bandied about that you can claim the foreign income and gain regime as the settlor to avoid the higher rate of tax, and your liability is capped slightly more helpfully at the lower rates, remains to be seen. There is certainly an argument that that's the impact of the legislation. If you're in the FIG regime, you can avoid the additional charge. Doesn't mean if you're avoiding the charge, that potentially one concern that's been expressed as well is that pot is then capable of attribution, remains within the trust, and it remains capable of being an income distribution to any other UK resident beneficiary. Generally, though, given that the whole premise is you don't distribute to anyone but the grantor during their lifetime, fingers crossed that complexity is unlikely to arise, but it's there.
Yeah, there will be people, and I'm projecting out into the podcast sphere. There were people listening to this who've probably switched off in the last 5 minutes and gone, I have not got the foggiest what you two are talking about. To those people, we hear you. I promise you we hear you. The message we want people to take is these reasons that Gillian and I have just been talking about on a technical level are why we want you to come and take advice before you come to the UK. If you're coming to the UK with a living trust, these are all issues that can be managed and worked around if we have the time to do so before you arrive. And ideally, come to us and speak to us in the UK tax year before you arrive, which means if you're coming to the UK in June, we want to have completed this planning by April 5th prior to your arrival, because that's the end of the tax year prior to the one that you come here in. So you don't have to necessarily engage with all of these tax issues, but know that there is a red flag being thrown onto the field to say, please come and talk to us before you come here. Let's say, Gillian, that someone's heard the first half of this and thought, great, I definitely won't do my living trust before I come to the UK, but what I will do is I'll make sure to set it up when I'm in the UK, because that'll avoid all of these horrible anti-avoidance rules that apply to offshore trusts, because it will never be an offshore trust. And we think we've avoided some of these rules. But if we are in the realm where we still have a settlement, am I not right that we still have to worry about there are other UK tax consequences to a UK tax resident setting up a trust? For example, there can potentially be capital gains tax and inheritance tax consequences upon the creation of a settlement. And just because you've been in the UK for a couple of years, if you accidentally settle the trust with UK assets, or you don't claim the foreign income and gain regime, and so on and so forth, or you're not even within the foreign income and gain regime because you've already been here for 4 years, there can be some really, really quite nasty tax consequences if the living trust in question that you set up happens to be a settlement. And we should work really quite hard to make sure that people don't have that position.
We absolutely should, Aidan. Yes, the days of the planning that would have been standard, where you encourage an individual prior to becoming deemed domicile to think about actually forming a settlement. And that very much applied to US persons resident in the UK due to the somewhat significant, shall we say, differential between our paltry nil rate band of £325,000 and, in addition, the US estate tax threshold of just under 15 million, $14 million. It's, chalk and cheese, day and night. So any US citizen who was in the UK approaching being liable for UK inheritance tax on a worldwide basis would categorically put in a large value of their UK assets to protect against a 40% IHT charge. Now we have to think very carefully, very differently. One, yes, are they going to trigger capital gains tax on the transfer of those assets into trust? Previously, the likelihood is you'd be able to get them to claim the remittance basis when putting the assets in. No longer the case if, as you rightly pointed out, they're outside the 4-year foreign income and gains regime. And now we really do have to be careful we're not triggering a potential 20% upfront inheritance tax charge on the value of the transfer. And this is because you would need to assess now whether or not it would be, for UK IHT purposes, a transfer of relevant property. And with the transfer to the new 10-year long-term resident rules post-April 2025, that is likely to catch a lot of people out and needs to be thought about quite carefully.
And let's think about that 10-year threshold, because it's a really important one, and something I've been saying to clients a lot, and with an increasing volume of anxiety and aggression, is about the impact of living trusts on their estate planning. It's something that I don't think is engaged with quite enough in an estate plan, because we spend a lot of time talking about the income and the capital gains tax consequences of living trust. We talk about will withdrawals suffer tax consequences? Will a beneficiary receiving money in the future have to pay capital gains tax? But I think particularly for the UK resident grantor, not enough time is focused on what the consequences of the existence of a living trust within the estate plan looks like, because something that is surprising to a lot of people that they learn is, let's say we have a a married couple and one couple has a living trust because they have some US assets. And despite the fact that the terms of the living trust say that the benefit of those assets after the grantor's death passes in some form either to or for the benefit of the surviving spouse, those assets won't necessarily benefit from the inheritance tax spouse exemption, which is otherwise, in many cases, a blanket deferral, if not avoidance, of UK inheritance tax. And so, whereas if we were married, Gillian, and I left money to you under my will, in a properly structured estate plan, those assets would benefit from the spouse exemption, and so we'd at least defer, if not try and avoid, inheritance tax. If those assets are held within a living trust, that is quite possibly going to preclude the inheritance tax spouse exemption from applying. That it may not be entirely consequential within the first 10 years that someone's a UK tax resident, because it's only their UK assets that are exposed to inheritance tax. But once that person's been here for 10 years, necessarily their worldwide estate, subject to the capital taxes treaty we have with the US, is inside the scope of inheritance tax. And that means the existence of that living trust poses a real danger to the availability of the inheritance tax spouse exemption, irrespective of whether the trust is a bare trust or a settlement for UK tax purposes. And so what I end up saying to clients a lot of times these days, particularly in this post-2025 world, or post, tax changes world, is if you want to be in the UK for the first 10 years and you want to have a living trust, in the grand scheme of things, we can probably make it work. Yes, maybe that throwback to the capital gains could be disadvantageous, but generally speaking, if you didn't create it that long ago, it can probably be made to work. Gillian and her colleagues can do the tax reporting probably in a slightly more easy way than they could before 5th April 25. But once you've been in the UK for 10 years, that's a really, really clear watershed where we need to think very carefully about the consequences of you holding material levels of wealth through a living trust or pouring over wealth into your living trust, because, as you said, the difference between our nil rate band of £325,000 and the US estate tax allowance of 13.99 million means there will be a lot of Americans living in the UK whose wealth falls between those two bands, who weren't expecting to pay US estate tax and might have thought they would get an inheritance tax spouse exemption. And then when I have to come and rain on their parade to say the way that you've structured your estate plan means that will no longer be available, that really surprises people, and trying to work them through those consequences and what the alternatives are tends to be a joy and a delight and a pleasure that I have on a frequent basis.
And you're not alone in that, Aidan. And you raised a very valid point. So ahead of that watershed being reached, it's absolutely mission critical that the structure of the settlement is actively reviewed to ensure that the spousal exemption can be made available, and amendments contemplated to the trust to make sure that it qualifies for the spouse exemption. There are ways that can be done in a settlement. It's all about the interest you provide to the spouse and ensuring that it's deemed to become the spouse's assets on your death. But that wholeheartedly needs a look. And you also need to consider the capital gains tax position as well. A lot of people think a benefit of passing assets on death is the capital gains tax uplift. So assets that they've had for a long time, appreciated quite highly. Because of our rules here in the UK, where we're actually a bit nastier than the US, and we tax lifetime transfers as if they were sold at market value, appreciated assets is often something people struggle with, but they're quite comfortable that there's a capital gains tax uplift on deck. I'll just do that. No capital gains tax for my beneficiaries. And it is another massive wake-up call that you have to say, that might not be the case if this is a settlement. You don't get that capital gains tax uplift on death. And with our capital gains tax rate now at 24%, and who knows where it will go in the future, that is a real
The post 10 years is definitely the more problematic spectre that looms on the horizon. The other thing that I do say to clients in their first 10 years, and this is my chance for the soapbox, is A very frequent occurrence when people would have put in place living trusts is they'll have the attorney put in place a will at the same time. And that will very frequently be what the Americans will refer to as a pour over will. So any assets that you don't hold in your name at your death get poured over into the trust, because the trust is the document that effectively contains the testamentary dispositions. The will is just a mechanism by which any residual assets end up into the trust. If that will is drafted in kind of default American terms by a default American domestic attorney, what will very frequently be the case is that that will be drafted to cover the individual's worldwide assets. There will be no territorial differentiation in the document. So it says, this will is my final will and testament and covers all of my assets wherever situate. That means if you die prematurely in the UK, even before you've hit that 10-year mark, that will is going to pick up all of your UK assets, which probably aren't in the trust, and it's going to tip over those assets into the trust.
Yeah.
That is an administrative inconvenience at best, because we don't need the living trust won't protect from probate in that scenario because the assets are still passing under the will. But at worst, you're also tipping assets that are exposed to inheritance tax and, as you say, give other rise to other tax consequences that are now flowing through a structure that is not designed for UK tax efficiency. But for a one-line change in the will that says, as regards my UK assets, leave them directly to my wife, or this will doesn't cover my UK assets, and you put in place a separate UK will, whatever the alternative may be. But people should know that the consequences of a simple worldwide estate plan from an American perspective could actually be giving rise to UK tax complexities. So anyone listening to this podcast who has a US pour over will needs to just check the territoriality of that scope, because I see that very, very frequently.
As do we, Aidan, yeah. Absolutely. And our advice, other than speak to someone like yourself, would be that actually it probably makes more sense, especially when you hit the 10-year mark, and you start developing increased commitments and tax liabilities in the UK. You tip this on its head.
Yeah.
Your UK will is primary, and you have a separate will for your US assets.
Mm-hmm.
And if that pours those assets into a US structure, depending on the beneficiaries, that's far less problematic, as you say.
Yeah. And if anyone is feeling like a real glutton for punishment and wants to know a lot more about whether they should have one will or two wills, there's a 2-part episode I recorded a few years ago with Chris Macklemore of Macklemore Conchnick, who I know Gillian also knows very well, all about the delights of how many wills someone should have. So, there's a good hour of content there for people to listen to. If they're feeling a real glutton for punishment. What I think this shows, though, is that people are still very, very keen to use living trust. We neither you or I, Gillian, we could be shouting to a blue in the face. We are not going to persuade people not to use living trusts. And so what I often will try and say to people is, well, what is the point of the trust? No one puts in place a living trust just for the sake of it. Let's give a bit more money to our lawyers to draft those documents, although they're always very welcome to do so. They're doing it for a purpose. And that purpose, to loop us right back to what you said at the beginning, is probate avoidance. And so what I spend quite a lot of time talking to clients about, and I'm interested to hear your thoughts from your experiences as well, is, well, what other solutions exist? Because if I can find you a different solution that gets us the same probate avoidance mechanism, but doesn't incur the same UK tax uncertainty, let alone disadvantages, but just lack of clarity, then wouldn't that solution be preferable? And usually I can persuade people that if that solution exists, let's move away from the living trust. The most common example, if we're not just talking about leaving assets via a will, because that won't avoid the probate treatment, is transfer or death arrangements, beneficiary designations, particularly on things like bank accounts and investment accounts. The US seems to be much, much further ahead on this than the UK, where every single account I seem to open, I have the option of naming some beneficiary of the account when I die, and so the account automatically passes to them. To my mind, that is a much more straightforward solution. It has the exact same UK tax consequences as leaving assets via a will, but we don't have probate. Do you see that same thing in people's planning?
Certainly increasingly on cash accounts, for sure. US banks, you're absolutely right, Aidan, are now quite comfortable. You designate a beneficiary, provide the death certificate. However, it needs to be notarized or just given a little bit more legal emphasis if it happened in the UK. that's what they're looking for. And they will therefore transfer the assets or access to the account to the beneficiary. So you're 100% correct there, Aidan. There are obviously non-financial assets clients often have that we need to sort of think about. You can normally convince someone that they don't need to put cash accounts into a living trust. They don't need to and can't put things like their IRA into a living trust. Well, they can, and they do.
Designate as the beneficiary, but
it doesn't matter, and it doesn't make any difference. That's all nice and straightforward. Investment accounts can be a bit more sticky. Some clients are now considering adding other beneficiaries during lifetime, making these joint accounts, putting a simple document together with their estate lawyer as to what the ownership is, to clarify income treatment during capital gains tax treatment during their lifetime, who should be assessed on that, who should be considered to own that. But with a jointly held account, it automatically transfers to the joint account holder on death. So we see that increasingly too. To avoid all of these things, that's another option. Partnerships are something that clients are increasingly looking at, particularly for real estate, and particularly where they have adult beneficiaries in mind. They can start that. It gives them the control, but it makes that issue of probate a lot cleaner, because if you have a partnership document, that dictates what happens on the death of a partner. You can consider other structures if a partnership's not for you. We do have a lot of clients, particularly with real estate, particularly where there's rental income being collected, because there's other benefits to this too other than tax, which are sort of legal liability,
asset protection, ongoing asset protection, creditor protection,
all of those equally critical things. But as a mere tax advisor, I'm not going to go further than what I've said. We can look at corporate structures where the treatment is the same on both sides of the Atlantic. And again, that can be a really neat way of including transatlantic families in one structure, because it works wherever they are.
A bit like the facts and circumstances thing you mentioned at the beginning with HMRC, with us as practitioners, it's also a sort of facts and circumstances that there isn't going to be a one-size-fits-all. There will be some clients for whom a more sophisticated structure, a family investment company or a family limited partnership or something might provide the answer. But there are also those clients that are more straightforward, for whom they just want to hold their wealth in a straightforward manner. And then we're left in that kind of, well, do you use a living trust? Do you use transfer death arrangements? Do you do what some of my clients have sometimes asked about, which is, well, for the one UK beneficiary, I'll hold her assets outside the trust. And you go, that's fine, but now you're holding 25% of your assets outside the trust, and you need to make sure you balance your accounts carefully to make sure that you've always got around 20% in that trust, or have some very sophisticated formula in your documents that say, blah, blah, blah. Lots of people like to come forward with different suggestions. And the thing I think I want people to take away with is there are always answers, and it's always a balance of competing objectives, exactly as you said. Tax efficiency in the UK is going to be but one of a number of different competing factors here. How important the UK is going to depend upon whether the grantor is here, where their beneficiaries are, how much tax is at stake, and their perception of asset protection. Do they have small children? Creditor protection? What are their assets, etc.? And you and I will talk for many, many more years to come to clients about, well, what does this look like for you? But so we can have the greatest impact, have that discussion with us before you put the estate plan in place.
Yeah, that really resonates with me, because one of the first things I say to a client is, don't talk to me about the tax. Leave that to me. Yeah. Talk to me about how you would like your assets to ultimately end up.
Yeah.
That's what I'm interested in. Yeah. Then leave the rest to the professionals you've sensibly engaged to make that happen as tax efficiently as possible. Yeah. Tax should never be the driving factor.
Yeah. Absolutely.
It is simply part of a suite. And sometimes those other points are more valid. Another context we see a lot is US matriarch and patriarch, and a multi-jurisdictional set of beneficiaries. And that's another area you want to kind of be engaging with that matriarch and patriarch as well, because you can really make a difference in those kind of circumstances. So that's where that conversation is even more critical, because you want them to feel that even though you're talking to them about UK and US tax complexities, you do appreciate that at the heart of this is a set of values they have, thoughts and concerns that they want to alleviate and make sure are not an issue when they're no longer here.
I mean, I said to clients quite frequently, a good estate plan thinks about what you currently have and what you want to pass to the next generation. But a really good estate plan anticipates money that you might receive and incorporates that flow of wealth into the estate plan. And so whilst, the American couple living in Wimbledon with a small child and a semi-detached house, their estate planning is important. What is particularly important is when you have the conversation with the client to say, well, actually, my father or my mother, when they pass away, I'm expecting actually to receive a not a substantial amount of money. And I say, well, two things to that. One, your own estate planning, there's an argument now which being more sophisticated, because on the expectation that your parents will die before you, we want to make this planning last. Let's worry about the planning being able to incorporate an additional level of wealth. But also, as that wealth comes to you, let's think about the tax consequences of that transfer across the Atlantic. And we can probably, between the tax advisors, the US-UK tax advisors in Everfair and a firm like Collier Bristow, we can probably have the greatest impact where we're actually talking to Generation 1 in the US and the transfer of wealth down to the UK, rather than the transfer of wealth from Generation 2 in the UK down to children in the UK. Of course, a good plan does all of it together, but I absolutely agree with you. The matriarch and the patriarch in the US are probably the people who hold the greatest keys to tax efficiency. So incorporating them into the discussion or having that conversation with them might be difficult, but is probably going to bear the greatest fruit if we're thinking about global and long-term tax efficiency.
Absolutely. You've got to have that conversation with the client. It is an interesting question that always has to be asked. Delicately, would you anticipate during your UK residence to receive an inheritance from a family member in the US?
To paraphrase one of my colleagues who I learned this phrase from, the very Victorian phrase, what are your expectations from your parents? Do you think we've scared people enough yet? Do you think people are worried enough yet about their living trusts?
I think if we've done this right, Aidan, people are aware but comforted that there are options and solutions. They just need to speak to the right people.
That I very much second, and speak to the people before the planning gets put in place. I have no doubt, because I said to you at the beginning of this episode, the episode that you and I recorded back in 2021 has proven to be one of our most popular episodes, I think, for several reasons, not least because you've been so gracious with your thoughts and comments, but also because the topic is one that resonates with so many Americans. I have no doubt, again, that this episode will resonate with people. If those people, Gillian, want to learn more about you, where can they find you?
LinkedIn, our website. We have got biographies which explain a bit about where we come from professionally, and the sort of work and things we've got a good level of experience in. So everfairtax.co.uk is a great place to start.
That's incredibly kind. Thank you, Gillian. To you, this listener and the viewer, thank you so much again for tuning in. I've been Aidan Grant of Collier Bristow. My guest today has been Gillian Everall of Everfair Tax. Please make sure to join us next time. Thank you very much.
Thank you, Aidan.
That's the end of today's episode. May I offer my thanks again to Gillian for coming on not once, but now a second time. I really am very grateful for her. You'll also be pleased to hear that we're now on a new podcast schedule, releasing first Wednesday of every month. Make sure that you don't miss an episode by liking and subscribing wherever you get your podcasts. And don't forget, we're now also on video, so make sure to Google Collier Bristow or look us up on YouTube to see me in glorious Technicolor. Until next time, thank you so much.